One of the most important steps to modernize your portfolio before the U.S. default hits is to diversify your portfolio across different regions, currencies, and risk levels. Diversification means spreading your money among different types of investments so that you can reduce your exposure to any single market or asset class. By diversifying geographically, you can also take advantage of the growth opportunities in different parts of the world and hedge against currency fluctuations. How can you diversify your portfolio geographically? There are several ways to do this, depending on your goals, risk tolerance, and time horizon. Here are some tips to help you get started. Use asset allocation or target date funds. These are funds that automatically adjust their mix of stocks, bonds, and other assets based on your age, risk profile, and desired retirement date. They are a simple and convenient way to diversify your portfolio across different regions and asset classes without having to do much research or rebalancing yourself. Invest in a mix of mutual funds or ETFs. These are funds that pool money from many investors and invest in a basket of securities that track a specific index, sector, or theme. You can choose from a wide range of mutual funds or ETFs that focus on different regions, such as US, Europe, Asia, emerging markets, and so on. You can also diversify by investing in funds that cover different sectors, such as technology, healthcare, energy, and so on. Customize with individual stocks and bonds. If you have more time and expertise, you can also diversify your portfolio by picking individual stocks and bonds from different regions and sectors. This way, you can have more control over your portfolio and tailor it to your specific preferences and goals. However, this also requires more research, analysis, and monitoring on your part. Vary company size and type. Another way to diversify your portfolio is to invest in companies of different sizes and types. For example, you can invest in large-cap companies that have established market positions and stable earnings, as well as small-cap companies that have higher growth potential but also higher risk. You can also invest in value stocks that are undervalued by the market and offer higher dividends, as well as growth stocks that are expected to have higher earnings growth but may not pay dividends. Invest abroad. Investing in foreign markets can help you diversify your portfolio and access higher growth opportunities than in developed economies. For example, emerging markets such as China, India, Brazil, and others have faster economic growth rates, younger populations, and rising consumer demand. However, investing abroad also comes with some risks, such as currency risk, political risk, and regulatory risk. Currency risk is the risk that the value of your foreign investments will decline due to unfavorable changes in exchange rates. Political risk is the risk that the stability and policies of a foreign government will affect your investments negatively. Regulatory risk is the risk that the rules and laws governing a foreign market will change unpredictably or unfavorably. Add complexity. If you want to diversify your portfolio further, you can also add some complexity by investing in alternative assets such as real estate, commodities, private equity, hedge funds, and so on. These assets can offer higher returns than traditional assets such as stocks and bonds, but they also have higher risks, costs, and liquidity issues. Therefore, they are not suitable for everyone and should only be considered by sophisticated investors who understand their risks and benefits. Rebalance regularly. Once you have diversified your portfolio across different regions, currencies, and risk levels, you should not forget to rebalance it regularly. Rebalancing means adjusting your portfolio to maintain your desired asset allocation and risk level over time. For example, if one of your investments has performed well and increased its share of your portfolio, you may want to sell some of it and buy more of another investment that has underperformed and decreased its share of your portfolio. This way, you can lock in some profits and avoid having too much exposure to any single investment. By following these tips, you can diversify your portfolio across different regions, currencies, and risk levels and prepare yourself for the possible U.S. default scenario. Diversification can help you reduce your market risk and losses, as well as enhance your returns over time.